Dick is typically described as an experienced investor. He's been managing his own portfolio for quite some time. However, all of his experience has only taught him one thing. He is a terrible investor. Dick has bought at the top and sold at the bottom more times than he can remember. Fortunately, his relationship manager Betty has finally convinced him that he should seek professional help. She isn't recommending a shrink, but rather a professional investment manager. Dick is keen to go along with her suggestion, but doesn't really understand what fund managers do, and is therefore a bit wary of handing over his capital. Betty decides to introduce him to some people who work with funds, so that he can gain a better understanding. Jerry is a fund manager that Betty knows. He manages an equity fund. Jerry explains to Dick that his fund owns a large portfolio of many different companies' shares. The idea of the fund is that, through his careful selection of the shares in the portfolio, the fund tries to perform better than the overall stock market. Jerry explains that a relatively large selection of shares is required so that the fund can avoid having too much exposure to individual companies. Jerry never invests more than 2% of the fund's money in any one company's shares. His fund also pays dividends, which are made up of the dividends that have been paid by the various companies in the portfolio. Jerry tells Dick that if he invests in his equities fund, then his money will be pooled with the money of the other investors, and each will get a share of the profits of the fund, the proportions being determined by how much money each of them has invested in the fund. Carlo is an analyst that Betty knows. He works for a fund manager who runs a bond fund. Carlo explains to Dick that he helps the manager to select bonds that the fund holds in its portfolio. The bond fund needs to invest and reinvest on a regular basis because it holds a large number of different bonds with different maturities, which are issued by different governments and companies. Carlo tells Dick that the fund aims to balance the yield that it can generate for the investors against the level of credit risk that it takes on the issuers of the bonds. In order to be slightly conservative, the fund only invests in issuers with an A rating or higher. The fund has been able to pay investors a yield of 4% per annum recently, which is a better return than Dick can get on the cash that he holds in his bank account. Silvio is a property manager that Betty knows. He manages properties for a real estate fund. The fund buys properties and either upgrades them for resale at a profit or holds them with a view to getting a return from any rental receipts and perhaps also some capital appreciation. The fund owns a large range of different properties that are rented by companies as offices and factories, by retail chains as shop locations, and by large hotel chains. The diversified range of properties helps to smooth the returns from the investments, since the fund is not too dependent on any one section of the economy. Investors in the fund are part owners of all the properties, but they cannot take the properties out of the fund. They have to sell their units if they want to exit the investment. In the meanwhile, they receive distributions of the income that the fund receives from the property tenants, and perhaps also some profits that it makes from selling any properties. Now that Dick understands how money is managed through funds, he's ready to make an investment. He asks Betty what she recommends. She tells him that just as funds invest in a diversified portfolio of investments, Dick should also buy a range of different funds. She says that he could construct a balanced portfolio by splitting his money between equity, bond, and property funds. Dick follows her advice and invests in 10 different funds that invest in a range of different asset classes and in countries around the world. In summary, funds pool money put in by lots of different people and invest the money to give those people a return. Different types of funds invest in different asset classes. Most funds will try to hold a wide variety of investments in their portfolios, so that they avoid having too much exposure to any single investment. If a fund receives income or makes a profit, it may distribute the income or profits to the investors. If an investor wants to exit a fund investment, he may be able to withdraw his money through a redemption process, or he may be required to find someone else to buy out his investment.